Hi everyone, welcome back to Infinity Wealth. Today, I thought we would talk about the winners and losers in the property market, especially since there's so much talk about Brexit and also possible recession going on. Today, we'd like to stay current. There is a vote in Parliament, so we don't know if we're going to get another general election, but at Infinity Wealth, we're always very, very current and let you know what's going on in the current market. So let's begin. So who are going to be the winners and in the property game at the moment? First and foremost, those people who have cash, who've managed to actually accumulate a lot of cash, they will be in a position where they can implement that cash to pick up potential deals, especially if the property market dips. So these are some of the winners. The other type of winners that you'll get is obviously people who have kept the powder dry as well, who haven't highly leveraged their property portfolio. So I'll give you an example. I have a very, very close friend who only does social housing. Okay, so he is an expert in social housing. He's been doing it for the last 30 odd years. He and I had a conversation about 2 years ago. You know, we could see what was going on with Brexit and everything else, and also the way, the market was going. He started to sell some of his HMOs and to pay down some of his debt. This sort of situation, he and I both know that when the proverbial hits the fan, basically those people who are in a better position to capitalize on it will make the most money. You have to understand market conditions first and foremost. So the sort of market conditions where we're at now, and it's all cyclical. So it very much depends on what's going on in the current market cycle. So in the current market cycle, we are beginning to take a dip, and it's not. I'd like to also leave you with one phrase, that I've heard so often. Okay, when you go to a party, if you're early at a party, it's always difficult. But you can always join the party once everyone is there. So if you bear that in mind, you don't need to jump in straight when there's a recession. You can wait to see what's going on. Also, in these sort of type of environments, those people who have maintained their properties and are to a good standard, if you consider tenants are going to find it really, really hard. Okay, so it's going to be quite a competitive market. You always have to think about your end user and your client. It is a business after all. So those people who have maintained their properties to a good standard and of a reasonable rent will always be able to rent those out. High gearing is a problem. Okay, so those people who are not highly leveraged, as I said about my friend in Northampton, those people that are not highly leveraged can now implement some of the leverage out of the system. If you are highly leveraged, it can cause a lot of problems, and I will cover that in the losers section in a short while. The other winners are people who already have more than one exit strategy. So let's say hypothetically, if you are doing a refurbishment, you know what the current market is. If you've got more than one exit plan, rather than just flipping it, you have done the numbers correctly and you've maintained and made sure that you are able to rent that property out if you're unable to sell it. So these are the sort of winners that you'll get as well. So people who understand the numbers. Above all, in this type of environment, you've got to keep a good credit score. After all, the mortgage market is quite tight, lending is quite tight, and that criteria, your credit score, is all important. Without a decent credit score, you will not be able to get a mortgage. Okay, you'll be relying mainly on outright cash purchases. You need to understand how to do your due diligence. So how do you do your due diligence? Okay, sticking with Infinity Wealth, we will show you ways to do your due diligence, to look at certain aspects of the property to make sure you're ticking all the boxes to keep you safe. At the end of the day, it is to keep you safe. You've got to treat property like a business, as I said. Vast majority of people do not treat property as a business. We need to keep it as a business. And at Infinity Wealth, we will show you, because we are business entrepreneurs. We're not just property entrepreneurs, we are business entrepreneurs. And we will always keep you abreast of it, such as this video to show you what's going on. So in the next section, I'll be covering the losers and where things can go wrong. Okay, in this section, I'm going to be talking about the losers. Some of the main losers are going to be developers. Developers often can't time the market, especially larger ones. So developers who have already been developing and are bringing stock onto the market with the downturn that's going on right now, they will have to look to reduce the prices or somehow rent out these properties. The other type of losers is, and the next section, I actually want to talk about a real incident. It is a cousin of mine who in 2008 went out, he's a Londoner, but he doesn't really realise how the market up north works. He went to Liverpool and he bought a 1-bedroom apartment in 2008, just before the crash, for 175,000. He bought it off plan. Now, the other type of losers are going to be people who buy off plan. If you are a serious property investor, you shouldn't really be looking at buying off plan. I want to also give you another example. In 2008, same time in London, often there were queues because developers were selling out of the apartments very, very quickly, and the prices were just rising and rising and rising from one guy to the next. I know of a story of a guy who used to go to the front end of the queue, used to put down his name and a small deposit to buy a unit, and then sell it on to the people at the back who didn't manage to get it, and he was making £5,000, right? That's when you know you're in a bubble as well. And that was in 2007, 2008. So these are just some of the examples. The other type of people who are going to be losers are people who try to flip but don't do their numbers. I'm all for flipping, but what you've got to realise in a recession is, or in a forthcoming recession, you've got to realise that you've got to do your numbers, have more than one exit strategy, right? So if you understand the numbers, you've got your exit strategy, you're fire enough to do it, and you've built in a decent margin. Above all, you've built in a decent margin. Stick to Infinity Wealth and we'll show you how to do that. The other people are going to be losers are highly leveraged people. Right, it could be large portfolio holders who've got multiple properties, but at the end of the day, they're working on a very, very skinny margin. Okay, so their rental income just about covers everything, and they are highly geared. These are the ones that are going to lose pretty big. So you've got to make sure that you're not over leveraged. In a recession, you've got to prepare. Remember, it's like taking an energy drink, right? Take the energy drink. Refresh yourself. Don't overdo the leveraging. I want to give you other example of London buyers. Now, I've got a very good friend. I've been in the London property market for a very, very long time. Now, he and I were talking, and possibly what's going on in the London market. One of the things is with the interest mortgage relief being reduced now, especially by following year 2021. Lenders are tightening up their criteria. So what they're doing is the stress tests are a lot higher. What's happened is a lot of London buyers in the past, what they've done is that because they've got so much equity in the house, they've bought the properties, then released equity to buy another property, then released the equity to buy another property. These guys are now highly geared. The London market has taken a downturn. The other thing is rents have also been dropping. I know there's talk about rents increasing, but rents, if you talk to real people in London and proper professionals, they'll tell you they keep maintaining the rents at the same price because they want to keep the units available all the time and filled. So if these people now try to refinance their properties because of the tighter mortgage criteria, they're unable to do it. The lenders are now saying, well, actually, you're failing the stress test. So you've got to be careful that you don't over leverage. I know there's loads of courses that teach you about pulling money in, money out. Yes, Different strategies for different areas for different times. You've got to understand that, and we do teach that. Right, so that was the London market. The other type of people are the ones that are waiting for the crash to be over. So these will all be the losers as well. You know, you've got to understand the flow and the dynamics of the market and what is going on. And we try and keep it very, very current to try and teach you that at Infinity Wealth. If you're in negative equity, and there are quite a few people up north that are still in negative equity, these guys will suffer. You know, when the recession comes on, if there is a recession, and it looks very strong indications that there is going to be a recession, if that happens, obviously people in negative equity are going to suffer. The other type of people that will suffer are people who basically go, what they've done is that they've gone to gear up very highly. You've got huge portfolios, highly geared. The lender will come back and say, actually, the property prices have fallen by 25%, hypothetically. You've borrowed the money on a ratio of, let's say, 80 to 20 or 75 to 25. If, and this has happened to a lot of my friends or people that I know in the last recession, you know, what has happened is because the mortgage lenders now have found that they need to sell some of their order book on, or their mortgage book on, they are looking at people who are highly geared, because they can go back to these individuals and say to them, okay, well, you've dropped below that minimum threshold, which is 80-20 or 75-25. So if you imagine, if property prices come down by 25%, and your agreement with the lender is 75-25 loan to ratio, the lender could easily ask you to say, well, we believe the valuation of your property is 25% less, so can you add another 25% into your portfolio so we can get that ratio correct? That has happened in 2008, where a lot of the banks were struggling. So you've got to be mindful of these sort of things. The other type of people is obviously people who need to sell their properties very, very quickly. So these guys will be the losers, and these are the ones that we're talking about right now. The ones who are able to take the advantage of the lower mortgage interest payments, the ones that are not highly geared, mortgage rates are actually dropping. If you're highly geared and the lender has already said, well, the ratio is not meeting our criteria, and also you failed the stress test, you can't take advantage of the lower mortgage interest rates to lock them in. So these will be the losers as well, because they're highly geared. The next section is really about, now you often find it on YouTube, there's loads and loads of people that are chasing the shiny penny. That I call it chasing the shiny penny syndrome. I have made $1 million doing this, doing that. Now I'm doing rent to rent, I'm financially free, I'm doing service accommodation. Now, in a recession, just put yourself forward. In a recession, and I've lived through 2 recessions. If this one comes along, it's my 3rd one in business. In a recession, what you're going to find is people are going to tighten up their belts. So you'll find that the rental market will become a bit more difficult. So those, like I said before, who have got good quality accommodation, who are able to reduce the rents and ride it out, will be great. Those people who are doing rent to rent and haven't done their numbers really well, what you're going to find is if you've got 1 or 2 units available all the time, you're not going to be making money. So you have to be mindful and do your due diligence on the area to see if you can ride this out. Service accommodation is the same. So service accommodation is like a hotel. In a recession, if you're a business person, you know that hotels struggle to fill rooms in a recession. They often lower prices. So service accommodation, what do you think? Unless you've done your numbers correctly, unless you've researched your area, how do you think you're going to fill that service accommodation? Because you're going to be competing with other people in a recession. I'm talking about a recession now, nothing else. So you've got to be mindful of that. So people who are doing those sort of things, just please be careful. I'm not saying that don't do it. What I'm saying is make sure you're doing it correctly. Work with people who understand, who are not really just selling you a course, but really understand what they're talking about. I hope you've enjoyed the video and found it very, very useful. We'll be talking about this topic in far more detail at the next J6 property meet, which is on October the 8th. If you get in contact with us, we'll let you know where that is, but it's at the Catthorpe Hotel in Slough. We will be talking at other property meets, so if you'd like us to present at your property meets all the data that we found, please get in touch with us. We hope you found the video useful. Don't forget to share our content, like our Facebook pages, on Instagram, and also there's a button up here somewhere or down there. Please share the video. We are doing this content absolutely free for you because what we believe in at Infinity Wealth is providing value to all our followers. If you have any topic suggestions, please let us know and comment below, and we will try and do a video for you. Okay, once again, thank you, and I hope to see you in the next video.